Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the Dow Jones Industrial Average has continued to go a little higher, and we are running into a multi-year pennant pattern right here. The pennant pattern is trading into that 12,720. It's getting a little bit above that, but chances are the markets are a little overextended. And based on this behavior, we have a huge sharp upswing in volume on this specific day. Chances are a lot of institutions are actually closing their positions and they're not entering into new positions. Again, typically whenever you see high volume, it usually happens during periods where stocks like to pull back quite a bit or quite substantially. And once volume starts to pick up, chances are that's when institutions are trying to get out of their positions. Let's go ahead and talk about the next chart, which is going to be the Standard & Poor's 500. Standard & Poor's 500 is trading at the 131.51 area. This is the SPY index ETF, by the way. And essentially, the options are pricing in further downside. And I really want to point that out real quick. We're looking at February. Okay, we're going to look at the February 2012 contracts. And yeah, this is ridiculous. But basically, it's trading at around give or take. And yeah, right now the options contract is trading at around $1.99 for the call options, and the put options are trading at around $2.72. $1.99, $2.72, and this basically means that market participants are willing to pay 25% more for a put option than they're willing to pay for a call option. And let's also consider the fact that that's what the people selling the put options for are willing to accept. Based on the risk, outlook of the marketplace. And right now we're going into the end of earnings season, so chances are markets are going to choke up a little bit and give back some of those gains they've had for quite a while. And once they give back some of those gains, chances are markets are going to pull back quite a bit, and that's the way it works. All things considered, though, when I look at the Standard & Poor's 500, let's go ahead and look at the March contract and see what market participants are thinking. And we're pricing in a little bit more of a time value into it, of course. But again, this is 132. Markets are barely, it's only 50 cents on the, it's not much. It's the time value represents much more than the actual contractual value. It'd take quite a bit for you to get in the money on these contracts. But essentially, people are willing to pay much more for a put option than what they're willing to pay for a call option going into March as well. And even in April 2012, SPY call put ratios, but not really the put ratio, but really the price ratios is what's more important. 438 for the call and 574 for the puts. So the put option side is on a winning streak, and that means that market participants are thinking that the stock market will go a little lower going into this in the first half of the year after earnings season is over. So again, the main things you really want to watch out for is that we're still at the upper ends of this multi-year pendant pattern. We have not really confirmed above it. We have one-day trading session above it. We'd have to confirm above it on the following session, which we haven't seen yet. There's a lot of volume going into this, and a lot of volume is really bad. I mean, I'll be honest to you. Typically, markets like to float up on lower volume, and they like to sell on high volume. So you're going to watch out for this high volume bar, and it wouldn't be surprising to see a continuation of these high volume bars and eventually a market pullback. Okay. That being said, I want to go ahead and talk about the next chart, which is going to be LinkedIn, LNKD. And it's the same story here. LNKD is trading at $73. It is a double topping pattern, but let's also consider what the options markets are saying as well in regards to this. And basically, the options market is also pricing in even further. What's going on is the 75 put options. I'll be willing to even go down to 72.50, right below the put and calls. Okay, so people are willing to pay $5 for a 72.50 call option in the month of February, but they're willing to pay $3.90 for a put option in February. So again, LinkedIn is kind of cheaper on the call option side, but that's also because of the fact that, again, some of it has to do with the fact that since it's 72.50, you're getting a buck worth, since it's currently trading at around 73.60. So I'll go ahead and go on two opposite sides. I'll go for the 75, and I'll talk about the 72.50 on the call and the put. The 75 call, okay, is trading at around $3.90, and the 72.50 put is trading at $3.90. So $3.90, $3.90 on both sides of this market. Now, here's the main point I want to bring about to you guys, is that when I look at this chart right here, one thing I want to point out is that people are willing to pay an equivalent amount for put and call options. So the market is relatively undecided. However, there's much more volume and there's much more volume, at least in the month of February, for the put options, but that doesn't really amount to much because there's much more open interest on the calls option side. And typically, when you look at this, a lot of people like to say, when you see markets and they have a humongous amount of open interest on one side of the market, chances are market participants want to pull the market and yank it back. And that's exactly what happened in LinkedIn. We got close to 75, options expiration, pulled back right from 75, and all those people who had call options in the market were pretty much losers. Going back to the SPY though, you got the 132 puts and calls, and same story here. But I'll go ahead and go down to the 131 put. Okay, 531, 438. So it's still the same story. In this case, I put the call options ahead, right here above the 131, and I put the put options at the same 132. However, the put option has some. Actually, the call option had some built-in value and still was priced well below the put option. But what happens when you put a call option that has some built-in intrinsic value and a put option with some intrinsic value, and still, the call option is substantially weaker? So I did factor that in a bit for the same period, but I also wanted to point out that yes, there is some value built in the stock price, but at the same time, it really made no difference. People are willing to pay much more for put options and call options as far as the indexes are concerned. As far as LinkedIn is concerned, not as much, but then again, there's a lot more volatility and there's not as much options trading in the stock itself. But when I look at the stock, it's trading at really high valuations. I think 1,500 price to earnings ratio. People aren't exactly certain of the earnings potential from professionals talking to each other on LinkedIn, and that's even if they do. The way I see it, as far as LinkedIn is concerned, how much money can they realistically make in the next 10 years? Because we trade at least on future expectations of around 2 to 3, 4, 5 years at the very least. And if 5 years down the road, nothing you can do right now is going to justify that valuation, why should we pay $70 per share? It just doesn't make sense. It's a lot of money they have to make up for in terms of earnings. You would have to basically, since you're so down the hole, you're only making $20 million in net income. You have a lot of revenue, but you don't have that much net income. You have a lot of expenses. It's really hard. Now you're going to squeeze the margins. You're trying to become a subscription-based model, and you're playing a game of margins with limited revenue growth at this point. And that's the main point I'm trying to bring out here. They're already charging their customers. They've set it in stone. They're going to try making money off of them. It was a free service. Now it isn't anymore. They're going to start charging a subscription, a premium, and we're going to see just how much saturation they can honestly get out of their consumer base over the course of a couple of years. My expectation is that it's not going to amount to that much, and therefore the stock valuation of $7 billion is not warranted, and chances are it should be trading anywhere from around $3 to $2 billion in market valuation. So that's why I'm very bearish LinkedIn, and I don't like at least the fundamentals of LinkedIn. Sears Holding is another story. Again, this company has had high debt, continues to accumulate debt, continues to accumulate inventory in the retail space. When you accumulate inventory, it means that you're buying product and you're unable to sell it. So you're holding on to goods that are taking up space on a sales floor. You're paying a lot of money in rent, and you're not generating any profit off that item. And because of that, when I see Sears Holding, I'm kind of concerned of, how much inventory are they holding on to, and yes, for the bigger ticket items, they have their own separate warehouse and blah, 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 refrigerators and this and that, but, Sears Holding has a wide range of items, and it's really hard to distinguish what Sears Holding really is anymore, and the brand value of it is also diminishing as well. A lot of hedge funds were short Sears Holding. There's been a lot of analysts who have been downgrading it, bickering about it, and basically, you're having this huge short cover rally, and this amount of volume can only be explained by institutions who've had a huge net interest short position, and they're just getting blown out of the marketplace. I'm just going to wait for this. I'm just going to wait for since Sears Holding is such a high beta play, chances are, this company is going to follow the market. If the broader stock market pulls back from this pennant pattern on the Dow component, chances are Sears Holding is going to follow that, and it's going to pull back all the way down. And it would be easy for me to net a 20-25% gain just by shorting the stock. Once the broader markets start pulling back, Sears Holding will fall flat on its face. Now, once it does, once it starts to do that, it's very easy to just go ahead and start shorting the stock. And that's what I plan on doing in the next week or so. Moving on, I want to go ahead and talk about Amazon. Amazon is another play that's been overvalued. I don't have the numbers on hand, but basically their revenues are less than stellar in comparison to Walmart, but their valuation is half of Walmart. It's really hard for me to justify paying $100 billion for a company that is growing at a pretty fast rate, but their revenues will nowhere near match Walmart in the next 5 or 10 years, but yet we're paying half the price for Walmart. And let's not forget the fact that Walmart is also growing over the next 10 years. So you got this huge spread difference between how much revenue growth is in Amazon, and even if Amazon was able to generate enough revenue over time, their operating margin has shrunk quite a bit based upon their recent Nook investments. So again, it's just a really, really overvalued company, and I would avoid this company. And chances are it's pulled back in options expiration week, and people got weaseled out of it. But it's going to pull back eventually, and chances are once it does, it's going to happen with the broader markets. Broader markets pull back, Amazon pulls back. When Amazon pulls back, chances are it's going to continue lower. I also want to point out that Amazon is still in a longer-term downtrend because this recent high wasn't able to break above its previous high. Higher, lower lows, lower highs. This is our previous low. This is our recent high, and we could continue this downtrend quite easily. Take care, folks. If you have any questions, leave a comment right below.